The broadcast is now starting. All attendees are in listen-only mode.
Welcome. It's really, really great to have you here today. It is a huge privilege for me to be doing this webinar. We've got some really interesting content to go through, and I'm very, very excited to have you here. What I would like to just mention, we've just started, so if everyone could just let me know if the audio is coming through okay before I get on with anything else. Just a yes or no in the chat if you can hear me. Yes, all right, great. Thank you very much. Thank you very much. That's fantastic. So the webinar will be quite interactive. We're going to stop and pause a few times and go through a couple of different concepts. But at any time, if the audio drops out, please let me know. And of course, I just wanted to touch on a bit of housekeeping. If you have a question at any stage, something that you'd like to ask about something that we're discussing, please do post it. No doubt if you have a question, someone else probably has exactly the same question, and you're doing us all a favor if you post them, right? I will endeavor to answer you at the same time. If it's a question that I'm going to answer a little bit later on, I may ignore it for the time being, but I won't be ignoring you. I will try and answer everything, but please feel free to ask away as needed. Right, let's get to a little bit. So my name is Glenn Howell. I am a professional money manager. I trade for clients. I have clients all over the world. I am a regulated money manager, so I'm one of the few guys in at least where I'm from that is doing things by the book, which really matters to me a lot. I don't take shortcuts. Everything that I do, I believe has to be done correctly, and it's also the approach that I follow in my trading. Part of what I do is I also mentor clients. In fact, that's actually where I started in the more retail space, and I mentor clients, and I work with a number of traders from all over the world, and we have quite an interesting dynamic going on, and yeah, so that's basically enough about me. I'm not going to go too much into the sort of details, sort of bouncing around and discussing my business and all that kind of stuff. And what I want to do is I want to get into the content. I don't think we're going to be here for too long, but I want to get straight into the content and get into the meat of what we are doing. So our topic tonight, and what you can see up on your screen here, is does your edge suck? And let's fix it if it does. Now, when I was putting together this webinar for investing.com, I obviously had a lot of different topics that I could talk about. So being a trader, it's a huge arena. There's a lot of topics that you can discuss. So why did I decide to bring this one to the forefront? And I think I kind of got on with it, and then it only occurred to me a little bit later on why this topic really matters to me and why I find it so interesting and so important. And I'm sure pretty much everyone here will agree with me when you understand my reasoning. And quite simply what it is every single day when you go online and you're researching trading and seeing what people's trading's opinions are and their systems and whatnot, you are inundated with a whole lot of rubbish. All right. And it's things like, buy my EA, buy my robot, and you will enjoy 50% returns a month, or, learn our system and never lose another trade, or find out how I turned $5,000 into $1 million, right? These things are everywhere. I'm sure we can agree on that. And, one thing that is quite challenging for me in particular is that it makes my life quite difficult as a serious, genuine trader, because there's so much nonsense and so much fluff out there that the idea of what real trading is gets lost. Okay, and that's what we're here to discuss this evening. We're here to discuss what an edge in trading is, how it really works, how you can take advantage of an edge, what an edge looks like, all right, and what is a realistic approach to trading. So that's what we're going to get into, right? We're going to understand if you're on the right path. We're going to understand how to get you on the right path if you aren't, and we're going to cut out all the nonsense that we see online. Just a question coming through, a question on the recording. I'll be completely honest with you, I don't know. That will be up to investing.com. My plan is to do a couple of webinars with them. I would certainly like to do a few more, maybe even a couple of live trades. We'll see. Maybe I irritate them too much with this webinar. We don't do any more, but just kidding. I'm sure we'll do a few more. Let's get to it then. I found a really interesting quote from Jack Welch. Now, Jack Welch was the CEO of General Electric from, I think it was 1981 to 2001. So he was the CEO for 20 years, and he turned General Electric around. He grew the company by 4,000%. All right, so to put that into numbers, that's, the numbers are just astronomical, and he really is a legend. You can read all about him. I'm not going to go too much into what he has to say, but there was Jack Welch building this massive company, and he already went into a massive company, and he grew it into something even bigger. And I found a really interesting quote from him here, and he said, "If you don't have a competitive advantage, don't compete." And I think that concept that Jack Welch has presented for us is, well, it's really key in trading, all right? And he meant it here from a business perspective. He was saying if your business does not have a competitive advantage, don't compete. But guess what? Trading is a business, all right? Some days you make profit, some days you take losses. You could think of a loss as paying your rent if you want to complete the analogy of having a shop or something like that. But trading is very much a business. You've got capital requirements, you've got cash inflows, you've got cash outflows, and your trading edge is absolutely critical. So to paraphrase this quote here, if we were to change it, we were to say, if you don't have a trading edge, don't trade. Now, we've got a number of traders, I'm sure, that are on this webinar, and if I said to you right now, define your trading edge, and if you can't, you have to stop trading, would you really be willing to do it? So think about that for a second, right? Because if you don't have a competitive edge, you shouldn't be trading. And it's only a matter of time before you are very likely going to wipe your account out. All right, just one or two questions. It seems as if a couple of attendees are battling with sound. I believe the majority is coming through. So if you are struggling with sound, I think perhaps it is your connection. Apologies for that. All right, let us move on then. What I did here is a little bit boring to start out with. I took a very, very generic definition of a trading edge. And this is the definition from investopedia.com. You can find it yourself. And I'm going to read it to you. Obviously, it's not ideal in a presentation, but it's a really good foundation for what we're going to go through here. And I think that would be quite handy. So a trading edge is a technique, observation, or approach that creates a cash advantage over other market players. It doesn't have to be elaborate to fulfill its purpose. In fact, anything that adds a few points to the winning side of an equation builds an edge that lasts a lifetime. Now that's obviously quite a mouthful and not that useful. So let's break it down. All right. And these are the three concepts that we are going to have a look at this evening from that very wordy definition. The first is that an edge is an advantage. The second concept is what they've written here, is that it doesn't have to be elaborate. And the third is that it adds a few points, an emphasis on the few points to the winning side. All right, so here the three of them are again, just so that everyone's on the same page with what we are having a look at here. So just to go through them very quickly, it's obviously an advantage. I've paraphrased that. I've changed it from it doesn't have to be elaborate to can or should be simple, and my emphasis is on the should, but we'll get to that in a second. And then the last point is that the edge is marginal. Now, marginal is just a fancy way of saying small, all right? So the definition here says that it's added a few points to the winning side. So before we go any further, contrast this concept of marginal or small to the sort of marketing fluff and if I may say it, outright lies that we often find in the trading space where, we're promised whatever it is, 4,000% returns, start with $100 and make $300 a day or whatever the case is. Does any of these sort of things, any of these claims, does that sound marginal to you? Right? And I think you have to agree that when something sounds too good to be true, it usually is. Okay, there are so many scams out there, and I think if we were just a little bit better armed as to what's normal in trading, as to what can be expected in trading, I think we'd all come a whole lot further. So let's just keep that in mind. We will come back to the sort of the ideas of what an edge isn't, and we will come back to all of these concepts. We're going to go into them, two of them at least, into quite a bit of detail, but just keep that in mind. All right, it's an advantage. It should be simple in my opinion, and it will be by definition, it will be marginal. Now, the three concepts, these three sort of elements, they all have to work together, all right? And when someone presents you with a trading concept or a system or an idea about the market, or they're telling you how to trade, you can apply these three concepts to that, all right? And if all three concepts do not sort of tick those boxes, if all three of them are not true, you don't have an edge. So to sort of visualize that, maybe, all right, we've got this little sort of diagram on the right, and you don't have an edge if any one of them is missing. Okay, so if I'm not going to go too much more into that, I think the concept is quite clear. All three of them have to be there, and I've called it a trading edge acid test, if you will. So when you're presented with nonsense and you don't know what to do with it, if it's any good or if it's complete rubbish, apply these simple principles. Is it an advantage? Can it or should it be simple? All right, and is it small? Is it marginal? If one of them is missing, you don't have an edge. You shouldn't be trading it. All right, are there any questions at this time? We're going to start drilling down into these things and how to actually specifically look for this information. So any questions, please let me know. Just pop them on through. I'll give you guys a sec to type them in. Question around sort of fundamentals, right? So not exactly what this is going to be about. I'm maybe just briefly on that, on my style of trading, in case anyone is interested. I am primarily a technical trader. As far as the fundamentals go, I think they provide the fuel that you need to kind of get the moves in the market. But I also think largely that the market is represented by the technicals of what is basically going on. So I hope that answers your question. All right, let's move along. Cool, no problem. Let's move along. Okay. What I'm going to do is I'm actually going to jump to the second part of our definition, is that it should be simple. And the reason why I'm jumping to it is we're going to sort of handle this concept that your edge should be simple. We're going to handle it really, really quickly. Okay. What do I mean by that? So you can obviously see what I've got up here, but let me talk through why I'm talking about the fact that your edge should be simple. So what we're talking about specifically here is your trading system. Okay, so that is when you open your charts, are you slapping on some sort of stochastic indicator, your RSI, MACDs, Bollinger Bands, whatever it is, whatever your approach is to the market, this is referring to your trading system. Okay, we don't have time to unpack this today. So if investing.com decide to invite me back for another webinar, I would love to do a series for everyone here on how simple trading can be. Okay, that's definitely the backbone of my approach to the market. You'll find my charts are very clean. If you've seen a couple of my articles that I've posted, you'll notice that I'm using simple, clean price action. All right, that's my approach to the market. I don't like to complicate things. I don't believe that it needs to be complicated to make a profit. This doesn't necessarily mean that more complicated approaches are wrong, but it is one of my beliefs that it doesn't have to be complicated to earn you a profit. Okay, and I just want to ask you two very simple questions, and they're rhetorical questions. I want you to have a think about them. Okay, and the first one refers to a bias that we all have. All right, and especially new traders. New traders in particular are really susceptible to this. When new traders see a chart, perhaps on Twitter or Facebook or some sort of social media platform, and a trader has posted it, and it's full of indicators. Okay, maybe it's even got some sort of custom indicator that the trader in question has had developed. All right, and it's some fancy kind of tool that shows you where the market is turning. Let's be honest. We're all impressed by these kind of things, all right? We're all impressed by what looks more complicated. So maybe, if you're one of these traders who's sitting with all the indicators and 6 trading screens and Bloomberg running on one channel, you've got your news sites on all the sort of online news sites, you've got your social media on another screen, so you're sitting with a whole massive trading desk. You've got a very complex approach. Does that necessarily mean that you are going to make more money? My answer to that is no, but one thing I will also add, obviously, this is a debate. I'm more than happy to have this debate with everyone else, and I'm more than happy to go into this concept of simple and complex in a lot more detail. But I just want you to think about that for now. We are naturally drawn to think that something that is more complex is going to make more money, and very often there is no proof whatsoever to support that. Keep that in mind, all right? And the second point I want to just briefly mention is that when you are taking a whole lot of losses, and no matter what you trade, no matter how you trade, there will be times when you take a whole bunch of losses, one after the other. Okay, that's normal. That's going to happen in every good system. And when you're taking all those losses and you're trading a complicated system, do you think it's easier to get out of that sort of drawdown if your system is complex or simple? Okay, because what happens with a complex system is your indicators start to confuse you, you start to get conflicting signals, and you end up being unable to pull the trigger and get out of it. So just keep that in mind. Again, I'm not going to go too much more into this. We just don't have time for it. It's a really big topic. It's extremely, extremely valuable. So we'll get into that hopefully on another webinar. I would really like to do that with everyone here. So maybe you need to let me know. All right, let's keep moving then. We're going to look then at the advantage, and we're going to look at the marginal component in detail in this webinar today. One thing I do want to just cover again very briefly is that a trading edge isn't a holy grail. Okay, so as a trading mentor and as someone who's been in the industry for quite a long time, I meet new traders every day who have been sold a pack of lies, to be honest with you. And they've bought some sort of product, or they've put all their hopes into some sort of trading system that typically they're marketed as something that never loses, or something that's going to triple your account in a few days, a few weeks, or whatever the case, right? We've all seen them. However they work, quite often they're martingale systems, and I'm not going to sit here and pull apart martingale systems. There's many different approaches to how these things are, but the reality is that they are not edges because they are not marginal. Okay, they promise something that is completely unrealistic, and they're selling you something that is never going to happen. And the result is most of the time a blown account. All right, if anything, these things wipe out your account. So all new traders, I've been there a long time ago. I was exactly the same as maybe some of you on this webinar are today. Obviously don't know, level of experience here, but many new traders are drawn to these kind of promises. There are no holy grails. Get used to taking losses. Make sure your system works and has an edge, which we'll get into. And then you don't care about the stuff anymore, right? You're not going to fall victim to any sort of sleazy sales tactics. Okay, enough said about that. Otherwise, I'm going to get into quite a rant. Let's have a look at this idea of your advantage. Okay, an advantage is your system. And I often tell my sort of students and people that I work with that your system has to do the heavy lifting. You have to rely on your system, especially when things get ugly. Okay, when things are going well, it's obviously very easy, as you would expect. But when stuff gets a bit tougher, all right, that's when it's time to rely on the system. And what we mean by an advantage in your system is quite simply that over time, you're expecting to make more money than you lose. Okay, and that provides you with a lot of confidence. Now, the way that we measure this, I'm sure many of you have come across this concept before, is known as your expectancy. And your expectancy is used using either past performance data, so previous trades, or it can be used using theoretical data from some sort of backtesting. I prefer past performance. I think it's a lot more valuable than just backtesting data, but we'll get into that a little bit later too. And then the last part of the system that we're going to discuss is how big a part luck plays in your trading. Now, this isn't a particularly popular topic. Us traders are often quite disciplined people. We think we know what we're doing. We think we can predict financial markets, and we don't like being told that luck plays a big part. But I'll show you a little bit later on in this webinar how big a part luck does actually play. Okay, let's have a look at this idea of expectancy. Now, expectancy is basically what you expect your system to return, whether it's going to make you money or lose you money, and also how much money it's going to make. So if you've got a whole bunch of systems and you are comparing which system you want to trade, the first thing you need to do is work out your expectancy of each system and pick the best one, right? The formula for expectancy I've got written down there too. So if you want to be a trader, and I assume everyone on here either wants to be or is a trader, a little bit of mathematics. is definitely going to be par for the course. All right, we're not going to get too complicated here, but you have to be willing to haul out your calculator, your Excel spreadsheet, whatever the case, and get on with calculating these kind of formulas, right? And it's pretty straightforward. It is your reward to risk ratio, which is basically your winners divided by your losers, kind of like an average number. And you multiply that by your win ratio or your strike rate. So if you won, let's say 7 out of 10 trades, your win ratio would be 0.7. And you subtract your loss ratio. Okay, so that's obviously out of 10, or however you want to work it, the percentage of trades that you are losing. Now, I understand that that can be a little bit complicated, but we're going to get into a couple of very, very simple examples. Let's get right to it. So let's say we're going to play a game, all right? And we're going to toss a coin. This is my favorite way of explaining expectancy. We're going to toss a coin, and we are going to bet on the outcomes of that coin toss. So you and me, all right? And if it lands on heads, I will pay you $1 or £1 or wherever you are. And if it lands on tails, you pay me $1. Okay, so obviously we can all intuitively see that this is not a good idea, but let's have a look at the expectancy formula. So the expectancy is 1, which is our reward divided by our risk. Your reward is to win 1. Your option or your potential loss is also 1. So that's 1 divided by 1, which equals 1. Multiply by 0.5. Okay, so it's a normal excuse me, it's a normal coin. You expect to win half the time. I expect to win half the time. So our win rate and our loss rate is exactly the same. And you will see that our expectancy comes out at big fat 0. So for the two of us to sit and play this game, we would be proving to the world that we are very, very silly. Okay, there's no point to it. I hope everyone can see that. Now, perhaps you find it a little bit amusing. I've written that we're both idiots playing this game. But, you know, when I was writing that, I had a chuckle at the same time. But when I was preparing for this webinar, I thought to myself, how many traders out there don't know the expectancy of the system that they're trading for real money against real opponents in the market, and they've never considered that from the get-go they don't stand a chance of making any long-term profits. And it kind of takes the funny side out of that. We'll get to sort of how to work on this and how to fix it if this is potentially a problem there. So it is funny to think about it in a game scenario like this, but how many of us are sitting throwing good money after bad money into the market and just hoping that things are going to change, that we're going to become better traders, the price is going to turn around, okay? Whereas we could simply apply a little bit of thinking, a little bit of maths to it, and have some of these answers. So let's not get caught. Okay, I'm going to use a different example just to explain how this would sort of improve. So let's say we change our game. We're going to carry on playing our coin toss game. And this time, if it lands on heads, I'll pay you $2. And if it lands on tails, you pay me $1. Okay, so our formula doesn't change too much, except obviously your reward to risk ratio is now 2 divided by 1, which is 2. Okay, your win rate remains the same, and you can see all of a sudden your expectancy is up. In fact, it's positive. This means that this system, or this game, okay, in trading we would think of it as a system. Right now we're just considering it as a game. This system would make you money. So if I said to you, do you want to play this game with me? Your answer should be yes, all day, all right? Because you're going to clean me out. Okay, I hope that that makes sense. This is definitely a good game to play. We want to be playing it literally all day long. You do. I would be crazy to play it. And again, how many traders don't even realize they're on the wrong side of it? So if you have a look at the heading of this slide, you'll see I've said your advantage and your expectancy through a better reward. So let's imagine a slightly different scenario. Obviously, I'm too smart to play this game against you. So you go along to Julian's Magician School. All right, he's got some stuff on YouTube. I must admit, I didn't actually watch this. It just served my purpose. You go along to Julian's Magician School and you learn his number 47 coin toss trick. All right, because you want to play this game with me. I won't play the one where I'm paying you $2 and I only won $1 or $1. So you want to improve your odds. You go along to Julian's Magician School, and all of a sudden, you now have the ability to throw a loaded coin. Okay, so this is the example with a better win rate. Okay, so again, if it lands on heads, I'll pay you $1. If it lands on tails, you pay me $1. But, okay, after graduating top of your class at Julian's Magician School, you could be sure to land the coin your way around 55% of the time. And let's just pause there before we even look at the expectation or the expectancy formula. Can you see that that would be an edge because it's marginal? Okay, you're only just better than simply throwing the coin randomly. It's marginal. So a system like this, if this was a trading system, this is something that you should investigate because it might have a long-term lifespan. Okay, let's have a quick look at the expectancy formula, and you can see I'm not going to go through all the numbers again, but again, the expectancy is positive. So you know off the bat, before you've even started playing this game with me, you have all the information you need to know that over time you expect to make more money than you lose. Okay? So that's how expectancy works. Okay? Anything above 0 is expected to be profitable with past data. All right, but the higher the expectancy, the better. So if you were comparing two systems and one had a much higher expectancy number, that's probably the one you want to trade because you don't want to trade too many different systems. It's confusing and you tend to mess up your risk. What I want to do now is I want to cover something that I alluded to in an article that I posted on investing.com during the week about how expectancy isn't quite enough. Okay, and what happens here is an example that I posted. I'm sure many of you saw it. It was a trade that I took back in, I think it was April or May 2016. I'm not sure. It was a long on the Swissy, on the dollar Swissy, and it was a really nice trade, right? It was following a system that had a really good win rate. I think that system's win rate is up in the 70s somewhere, 70% strike rate. Really good. The trade itself had an excellent reward to risk ratio, or commonly known as R. Just the letter R is what it's abbreviated to. So that was a really great trade. But there was a problem with that trade, and I said that I would talk about what the problem with that trade would be. And here's how you can think of it, right? Let's run another idea past sort of what we've been going through and plug another system, an imaginary system, into our expectancy formula. So let's imagine a system with a 2-to-1 reward to risk ratio. So what does that mean? That quite simply, that means for every dollar that you risk, you expect to make $2 back. And your win rate or strike rate is 70%. So you expect to win 70% of the time. Is this a good system to trade? Yes, absolutely right. Fantastic. Numbers like that are solid. The expectancy number 1.1, fantastic. But obviously the bottom half of the slide is what I'm getting to here. Okay, and this is what the problem is and the challenges that we have to deal with. What if this system only trades twice a year? Okay, so if we were being responsible with our trading, and let's say we risked 2% of our capital per trade, in a year we expect to make somewhere between -4 and 4.4%. So that doesn't sound too great, does it? Okay, with a system that's got so much sort of power and the numbers look so good, why on earth are we only coming out with 4.4%? Obviously, the answer is obvious. It doesn't trade often enough, does it? But before we sort of, just as sort of a side note, before we completely pull apart the idea of ending the year 4.4% up, I can tell you that the majority of retail traders, especially in highly leveraged products like Forex, which is obviously my specialty, and things like that, the majority of retail traders blow their accounts within 3 months anyway. So if our imaginary trader here was up 4.4% at the end of the year, guess what? He's actually way ahead of the curve. But that's kind of beside the point, isn't it? We want to focus on good trading here. We want to focus on responsible trading here. But so if we just look at the system, and let's imagine the scenario. Let's imagine we were this disciplined trader, and let's assume we made 4.4% in the year. But let's weigh that up versus all the effort that we put in, right? So you will know yourself, no matter how long you've been trading, you will have experienced stress in trading, all right? I don't know I've never met a single person who was born to trade. Everyone has a learning curve. Obviously, some people never achieve their goals, and this webinar is hopefully a step in the right direction, but trading is stressful. You're sitting in a position that's not going your way. The wife doesn't pass you the salt quick enough, so you're snappy at the dinner table. Your kids are, sort of tugging on your shirt. They want to talk to you. You're watching every single tick on your computer. You snap at them. You're grumpy, right? These things happen. Okay, you get a new position and you think, well, should I take it? You're watching charts. Let's imagine you're watching daily charts, and we've got 250 trading days in the year. All right, and let's just assume you're trading daily candles and 30 pairs. I mean, we're talking a huge amount of information you have to take in, and at every single day you've got to make 30 decisions on 30 different pairs whether you take a trade. How much effort is all that for 4.4%? And for me, it's just not good enough. All right. It's just not good enough because the effort doesn't match the reward. Okay. You're putting in so much effort and so much discipline, and for what? Okay. So, what do we do about it? Well, what happens typically, and this is not the ideal scenario, but what happens typically is we start to feel the pressure. Okay. We start to take setups that aren't as good. Something sort of happens along in the chart and you think, well, this doesn't quite meet my criteria, but man, I haven't had a trade in 5-6 months. I'm going to go for it. I'm going to pull the trigger. Okay, you don't follow your rules. What happens? You probably lose. All right. The other thing that happens, and I see this all the time, is that you go out and you start looking for systems, often inferior, that aren't very good. Okay, and enter the Holy Grail again, right? We all go back to it and we say, oh, my system's never going to make it happen. I'm putting in all this effort. I now have to go and I've got to look for something else. I've got to find something that trades at least twice a week. I've got to scratch that itch, right? I've got to scratch that trading itch. I can't just leave it alone. What I'm saying to you here is that the frequency of your trading system matters. Okay, the quality of your setups matter, but the frequency of your trading system also matters. All right, and people generally don't want to take this into account. We battle with it sometimes. Okay, it's a difficult concept because if the frequency of how often you're trading doesn't match how often you want to trade, you're going to start doing silly things. Okay, so if you know in your heart that trading twice a year is not good enough for you, and the system that you want to follow will only give you that kind of setup, you have to find a new system. Okay, there's no two ways about it. So you need to acknowledge it for yourself. Let's have a look at an expectancy here. So I've sort of changed it up. This is a system with a 1.1 to 1 reward to risk ratio. So what that means, it's obviously a bit of a mouthful. Sorry about that. But what it means is that for every dollar you risk, you have the potential of making back, $1.10. Okay. Happy with that? And a win rate, again, we've got a sort of a slight edge on the win rate of, what do we have here? We've got 55%. Okay, so it's not fantastic, but it's there. Okay, we've got an expectancy 0.115. Now in this system, let's assume that it trades twice a week. Okay, and you can run the numbers for yourself. But that's a potential return, and we're not at all assuming they're all going to be winners. Of course not. We're working within the win rate here, but again, risking just 2% of our trading capital. That's a potential return of 31% a year. Now, do you see how the expectancy number is much, much lower, but the frequency makes up for it? All right, that's something that I really wanted to share. Okay, that's really, really critical. Acknowledge yourself. You have to find a system that meets your personality. All right, all the trading psychology in the world is not going to help you at all if you don't find a system that matches your personality to begin with. Okay, so don't feel guilty. If you're feeling that you're not trading enough, figure out a solution and fix it. Okay, it's critical to your trading success. All right, a couple of questions that have come in. I'll go through one or two of them a little bit later, but a couple of questions on the idea of marginal. So we're gonna get into that now, actually. So let's move on. All right. Okay. If there are any other questions, please do let me know. So. Again, if you're sort of joining us a little bit later on, this idea of marginal trading, it's not that we want our systems to have a small marginal element to them. It's that we don't really have a choice. Okay, real trading has a marginal element to it. I've met a lot of people in the industry, a lot of people that have been in the industry for a long, long time. And the guys that stick around, the guys that are doing this year in, year out, that are managing client funds, that are growing their cash pools, they're not pretending that they've got systems that are hauling in 40% a month. Okay, these systems are marginal because that's simply what's possible in realistic trading. All right, it's not what we want, it's what it is. Okay, let's keep going. Okay. I want to go through another example here. I do apologize. There's a lot of numbers, but it's certainly the most powerful way to go through these concepts. So we've already been through this system. This was the system, the coin toss system, after you had gone to Julian's Magician School. All right. And this is a system that has a 1-to-1 reward to risk ratio. In other words, you stand to lose exactly what you stand to make, but you win 55% of the time. So this is what we would call a slight edge. Okay. We've already worked out that this system has a positive expectancy. Now, what I've done for you here is I've simulated this system over 100 trades. Okay, so how would this system perform in the market over 100 trades? And here's a little graph. All right, so you can see the x-axis. I've specifically left off the axis descriptions for a reason, but you can see the x-axis is 0 to 100. Those are your 100 trades. Okay, and you can see that they go along there. Now, this system, if we were to think about it, it's marginal, it's an advantage. The frequency is good. Let's assume those 100 trades happened in 100 days. Okay, I don't think anyone would be too upset about that. And then the y-axis, that would essentially be an R, a reward to risk return, or you could even consider it a percent, right? So if you were risking 1% per trade, what do you stand to make back? And just looking at these numbers, I mean, we're 100 trades in and we are 25% up. That's fantastic. I'd take that quite happily, right? And even looking at the equity curve, there's a few drawdowns in there. There's a drawdown in the middle, but really it doesn't look too bad, right? I don't know too many traders who've been doing this for a while that wouldn't be unhappy with that, okay? But remember, this is a simulated account, okay? So this is a simulated result based on our graph or based on our system. Now, this was just one simulation. What I did is I took this system and I simulated it a whole bunch of times. In fact, I think I simulated it 1,000 times, okay, just to show you how different a result you could get. And what I'm going to show you in the next slide, if it goes there, apologies. What I'm showing you on this slide is just 10 versions of the same simulation. So take this picture in for a minute. It's very, very important to understand what's going on here. This is the exact same system. This is a system with a 1-to-1 reward to risk ratio and a 55% win rate. Okay, so what on earth is going on here? How is there so much variation? All right, so these are just sort of 10 ones that I picked. I picked some of the better ones, I picked some of the middle ones, and I picked a pretty bad result there. Okay, how on earth is there so much variation between what to expect? In fact, what I want to show you next is the best versus the worst simulation over about 1,000 attempts. Okay, and I mean, let's have a look at the numbers. The best simulation, I think it ended up at around about 40% return over 100 trades. I mean, that's just phenomenal. And the worst one, I think it ended up at about minus 16%. So let's imagine this as a scenario. You start trading, and a trading buddy, he comes along and he says, well, I want to trade this system with you. This looks great. Let's trade it together. He starts trading and you start trading. Let's assume his curve is the nice green one that's making him a lot of money, and your curve is the red one that's losing you a lot of money. You're trading the same system with the same rules, with the same expectancy. What on earth is the difference? And the difference is pure luck. Okay? And what I mean by luck is I'm talking about the random distribution of wins and losses within your trading system. Okay, so your system has a win rate and it has an average winner size. We all know that, but we cannot control the random distribution of wins and losses at any given point. Okay, so in the green graph, or in the green line that we've got up here, for anyone who's colorblind, I do apologize. I should have noted that. But the green one's the one on top, doing quite well. In the green graph, the random distribution of wins and losses is pretty simple to understand. We simply got a lot more wins than losses, and statistically, there's nothing strange about that. Okay, in the red graph, on the one at the bottom, we got more losses than wins. Okay, and that ended up that we are down. Okay, that we're down over the same period. So just keep that in mind. Okay, and I've got a little sort of blurb here that I wanted to try and explain this concept. I know it's a little bit difficult and it's not something that we often come across, but we know that random events, things like the flip of a coin or the outcome of a single trade, have certain probabilities, right? We all accepted that when we said that our system has X win rate. The problem is that we think that things will be what's known as regularly observable. Okay, and the best example, again, is to go back to a coin flip. So if you and I were playing the coin flip game and we did a whole bunch of flips and we got 9 heads in a row and then tails, we think that that's strange. Okay, but it's no more unusual than if the coin flip simply alternated heads, tails, heads, tails, heads, tails. But the second one feels fine. Okay. In fact, both have exactly the same probability, and it's exactly the same you will find in your trading. Okay. Our win rate system, or the system that we were considering here, could have 20 winners in a row, or it could have 20 losers in a row, and that's within the normal distribution, okay, of wins and losses. And that comes down to pure luck. So luck plays a part, all right? And the size of part that, or the size of the part that luck plays, is something that we will consider now, okay? And what to do about it, what to do about this element of luck that you can't control, all right? You can't control whether your next trade is going to be a winner or a loser, or the next 10 or the next 100, okay? You don't know. You can't control it. The one thing that you can do is accept that it is going to play a part. And the second thing that you can do is to get your expectancy up, okay, that expectancy number. So if you remember the system that I simulated for you here, yes, it had a positive expectancy. Yes, something like 90% of the simulated runs were positive, okay, but the expectancy number itself wasn't too great, okay. It was sort of 0.1, I think, something like that, right? If you get that expectancy number up, in other words, if you have a much better win rate, or your winners are much bigger than your losers, or a combination of both, luck plays far less of a part. All right. I hope that sort of explains that concept a little bit better. Are there any questions on that at this stage? Maybe we should just have a quick look. Anyone want to, or any sort of points that you'd like clarification on? So a couple coming through. Sorry, give me a second. Okay, give me 1 second, folks. Thank you very much. Okay, I'm just going through a few questions. I promise it won't take me too long. Okay, lots of questions on the recordings. Yes, I believe they will be available. Don't worry about that. I believe most of them will be available. Okay. Okay, so a couple of questions just on the concept of expectancy. How do you get it up? Well, I'm just going to shoot back a couple of slides. I just want to cover that because that is important. All right, if you have a look at the top line here, okay, you need to work on your system. That's what it comes down to. Your expectancy is derived from your trading system, right? And the numbers are quite simple. It's how big are your winners relative to your losers, and how often do you win versus how often do you lose. And if your expectancy is not a really strong, solid number, don't expect your system to make you money. Okay, so you need to know these numbers to be able to see if your system is going to make you money or not. And if the answer is that it is not going to make you money, you need to fix that. And we're actually going to get into that in a second. I hope that covers that there. Okay, let's put it all together. We're not quite ready to sort of wrap it up just yet, but I want to just put this this concept together. All right. The first is that you want your expectancy big enough to cut out as much luck as possible. And typically at this point, I get asked, what is a good expectancy number? Keep in mind, we did discuss the frequency of how often you trade. So, if you're someone who's trading 3-4 times a year, and there's nothing wrong with that at all right? But if you're someone who's trading 3-4 times a year, you want a really high expectancy number. If you are trading a system that trades a lot more frequently, a lot more often, you can afford to drop your sort of expectancy because you'll get the return simply by trading more. It's kind of a trade-off between the two of them. So there is no ideal number. It simply needs to be positive and as big as possible. Okay, as big as possible. I guess the bigger consideration is you need a system that's going to fulfill your needs, right? Trading systems have to be practical. They have to fit into your lifestyle. They have to trade as often as you feel like you need to trade. All right. You can't be getting up and I don't know why I still see this so much. You can't be getting up at 3-4 o'clock in the morning every single day checking on trades and things like that. It's not healthy and it won't last. Okay, no matter how much you want it to. I've seen it. You will burn out and you'll start making silly decisions. Obviously, there are exceptions out there. Maybe a couple of you are on this webinar, but for the vast majority of us, we have to find systems and we have to trade systems that work within our psyche, that work within our belief system, and that work within our lifestyle. Okay, so that's really, really important. As I mentioned at the beginning of the webinar, I'd love to do a few more of these, and perhaps we can look at specific, simple systems and give you some ideas. Okay. The second point is that your trading edge needs to trade often enough to be relevant to you, okay, and stop you from taking stupid risks and buying silly EAs and buying into these adverts that you see all over the place promising these ridiculous returns. It's nonsense, right? We all know it's nonsense. So you've got to make sure that your trading system scratches that itch. Finally, if it works, the result, the profits, will be small. Okay, the risk will be small, but small enough not to wipe you out. Right? Most traders that I know have wiped out several accounts, and you know what? It's okay. Okay, if you've wiped out an account or two, don't feel bad. You're in good company. I think the majority of us had. It's almost like a rite of passage. But the point is that you want your winners and your losers. You want the risk that you're taking to be small enough to not wipe you out, but big enough to add up over time. Okay, that's a numbers game. What you're doing here is you are learning to trade professionally. You are learning to take a professional approach to the market by developing your edge. Okay, what I wanted to just present you with here is a kind of a little flowchart of how you can look at this here. So I think this may answer also a number of questions of sort of how you may approach this and where you are at. You'll find yourself somewhere in this diagram, I guess. And the first question is, do you know what your expectancy is? And I'm quite literally asking you, all right, if you don't know what your expectancy is, stop trading. Stop trading right now, all right? Measure your R, which is your reward to risk, and measure your W, your win rate, and work out your expectancy. If it's positive, all right, then we'll move on to the next step. If it's not positive, stop trading, don't start again, and find a new system, okay? Once you've got your expectancy, simulate that system at least 100 times, okay, in the way that I've done that simulation. And I understand that it's not that straightforward to do that, but we'll get into that in a second. But you want to simulate your system as many times as possible, at least 100 runs of it. You want to see that, you know what, how much of a part is Lady Luck going to play in my system? How much are the random distribution of wins and losses going to make a difference to how much profit I'm going to make? And if the majority of your runs, and by majority I mean sort of 95% plus, are positive, then trade it. All right, stick to it and trade it through thick and thin. Sometimes your systems will have a down period when they're not doing so well. The key is to keep pulling the trigger and keep going with that. Okay, that's a whole other webinar on its own that we don't really have time for, but that's the idea. But if you don't know your expectancy and if you haven't never worked it out, stop trading. All right, right after this webinar, stop trading. And I'm quite serious about this. Okay, so the next step here, is really yours. Okay, are you going to do the hard work now and start looking at your system? Okay, are you going to put in the hours to see the success that you want? Now, I'm also quite happy, and I think the next slide is what will show you what I mean by that. Is I understand that we've been through quite a lot of concepts here. We're a fairly, we're not a huge group. There are a good number of attendees in this meeting, but I'm more than willing to extend this offer, and the biggest reason why is I know the majority of traders are too lazy to go out and do this. Okay, and I hope that you prove me wrong. Okay, but my promise to you is that if you're serious about getting your edge right and you want help, I will personally reply and attempt to assist you. Okay, as I mentioned in the previous slide, you're the one who's going to be doing most of the work. I will be pointing you in the right direction. Okay, and because there are no shortcuts, you have to have confidence in your system. That's one of the elements, and you have to be able to run these numbers for yourself to be able to get your edge and see if your edge is going to be good enough. Okay, so if you've been trading blind, if you've been sitting and wondering if your luck is going to change, maybe, or the markets have been difficult lately, that's my favorite, or something along those lines. If you've been sitting trading and hoping things are going to turn around, stop it, right? Stop it. Let's get serious about this and let's approach it like a business and like the professionals that we need to be if you're going to make a profit. Right. So like I said, I'm willing to engage with every single person here. I really am. If you take me up on the offer, I will attempt to help you as best that I can. Okay, that's my offer to you. So, are there any questions at this stage? I believe that is my last slide. Let me see if I can get the questions up here. I think we've gone through kind of most of them. I think I may have missed one or two. If I have missed yours, I do apologize. It was not it was not intentional. Some of them tend to come through a little bit quickly. So let's see what we've got here. Okay, I'm just going to sort of work back. We've got another 10 minutes or so. We might as well use them. I appreciate everyone's time tonight. Really appreciate it. I'm going to work through them just as we go, and we'll see how many I get through. Okay. What program did I use to use those simulations? I used good old Microsoft Excel, and I'm sure I've got it lying around somewhere. That I can forward that along if you're interested. It's pretty straightforward. I like Excel. We don't need anything fancier than that for a little simulation. Another good question here, Abhishek. Apologies if I pronounce your name wrong. You mentioned if it's working more than 95% of the time when you trade it, 95% is a big number. Does it need to be that high? So yeah, that's a good question. You know what I found is that even a system with a pretty poor expectancy, most of the time, as long as the expectancy was good, then you were probably fine. So you're right. You probably don't need to be sort of 95% up. I like it to be as high as possible. Question for the previous slide. I assume you're meaning this one, the kind of the flow chart, right? I'm sure everyone's got my email address if you're going to take me up on the offer. Okay, let's keep going through questions. What do I think of the Kiwi yen? It's been pretty bullish lately. I've been riding it up on a couple of systems. I tend not to fight the trend. I tend to like to go with it. Kiwi's taken a bit of a knock over the last few days, but I think it's still a little bit temporary, but we'll see. All right, we'll see. Okay, that's a question, but you're offline already, so let's move on. Okay, I think we've pretty much covered everything. Thank you very much, everybody. I do appreciate it. Oh, one more question around about what system I use. So I am primarily a price action trader. That means I like to use support and resistance and price action moves. So that would be anything from kind of larger patterns, so things maybe like channels, or what would be a good example? Boxes, breakouts. I don't know all the fancy names for them. I've never bothered too much with all that kind of stuff. Even down to individual candlestick formations. So things like things like a big engulfing candle, right? I'll have certain criteria for how I would like a candle to look. Something along those lines. So I'm primarily a price action trader. Appreciate all the feedback. There's some really nice comments there. Thank you very much, everyone. I do really appreciate it. How to measure R and W, just very briefly to cover that. So what you would need to measure your reward to risk and your win rate, you would need historical data would be the best, or back-tested data. So you can literally sit with a what would be a thing? You could sit with your MT4, right, and a pen and paper, and if you push F12, you can try maybe when this is done. If you push F12 when you've got MT4 open, if you want to use MT4, it will advance your chart by 1 candlestick. You can also use packages like Forex Tester. I'm a big fan of Forex Tester, but it's a paid package, but it's extremely good. You can use something along those lines, and you can basically get good backtesting data. What you need is for your backtesting data, what you need is you need to be able to not look ahead into the markets. And of course, if you're someone who spends a lot of time in front of the charts too, you'll also have a general idea of where price is going. So go to a period in your charts that you know nothing about. Maybe you weren't trading in 2010, for example. Have a look at 2010 and advance the chart 1 candlestick at a time and trade realistically in real time, pen and paper. Work out, write down your trades. Did you win? Did you lose? How much did you win? How much did you lose? That's how you will build that R and W history. But of course, if you've been trading for a while, you've got that trading data in your trading package, whatever it is. Now, if you're too scared to do that analysis, that probably tells you something about your system already, right? But the point is that no one starts out, I mentioned it at some point in the webinar, no one starts out pre-programmed, if I can put it that way, to trade. Okay, we start out and we suck at it, to put it plainly, right? We've got a lot of biases, we've got a lot of, kind of the way we think and how we second guess ourselves, and we're scared of taking a loss, and we're just bad at it, okay? We really are just bad at it. There's no two ways about it. It takes a long time to work through those issues and to understand what individual issues you're going to have. So if you're finding yourself in this position where you're not happy with your trading, where you're not letting the system do the heavy work, your system is a tool. My old man always said to me, when I was swinging a hammer, he said to me, let the hammer do the work, right? Hold it properly at the bottom and let the hammer do the work. And his lesson is even more true in trading, right? Let the hammer do the work. Let the system do the work. So if you find yourself that you're not there, okay, don't give up. Don't carry on doing what you've been doing. Okay, you can do it better. You can be better. You can trade better, and you can get a lot more serious about it, and you can do really well. That I do believe. There's a very famous experiment. I'm sure many of you have heard of it. The turtle traders. I'm not going to go into too much detail about that. But what it was, basically, it was a bet between two very, very famous traders. And one of them said, I can teach anyone to trade. And the other guy said, no ways, you have to be a born trader. And the guy who said, I can teach anyone to trade, proved himself correct, right? He got in a whole bunch of people that knew nothing about the markets. And as long as they were disciplined, yeah, absolutely, wear the turtleneck, yeah, 100%. As long as they were disciplined, they made money. Okay, and it was a very mechanical trading system. I've actually got the turtle trading rules here. I don't know many people who are capable of trading it. It's a very difficult system to trade. Not that it's complicated. It's actually dead easy. But where the wheels fall off, if I could sort of put it that way, is that guys tend to get scared, right? They take a whole bunch of losses on the chin. I think you can take 4 or 5 losses in a row quite easily on a trend trading system, and it's really, really difficult to pull the trigger. Okay, and I think a lot of people fall down there, and then obviously the other one is risk management. I think especially new traders, we all tend to risk too much. We think we need to risk a lot to make a lot. I mean, I'll share here. I usually risk less than 1% of my trading capital per trade. You need to be able to sleep at night. You certainly can't be worried about your capital on the line, because that's when you start to do sort of silly things, right? But again, most of these concepts they're discussions, okay? Just like the market is constantly moving up and down because everyone's got a different opinion of it. Trading is very similar too. There's lots of different approaches. There's certainly no one right way. So I think we're about a minute to go. I'm going to shut this down now. I thank you all very much for joining me. I do appreciate it. I'm sure it's late in some parts of the world. You've got my email address. You can also Google and you'll be able to find us. Let's see what we can do about it. Have a good evening for everyone, wherever you are. Good lunchtime, whatever it is. Enjoy. I hope to see you all again quite soon. I really enjoyed it. Catch you later.